Hi everyone, this is Bruce Fleet with Fleet Capital Management. It is November 20 at about 2 p.m. Pacific time. It's Thanksgiving week. I've been promising to show you a short video of what these technical bull and bear markets look like so you know what I'm talking about in my morning emails. And I've just been very busy with the market, but I thought this would be a great time to get this done for you because in about 15 minutes I've got to run out and do the Christmas lights. If I don't have Christmas lights up and ready to go by Thanksgiving, then my penalty is cold and stale stuffing. So I'm going to get that done today because I love stuffing. So what you're looking at here is called Think Pipes. This is the institutional trading platform that I trade on. I'm not going to go through all of it because it's unnecessary. We're going to focus on this chart on the right, and then I will come back and explain to you what the chart on the left is. But for right now, we'll just focus. Let me make this bigger. We're going to focus on this. What we're looking at right now is DJI, which is a symbol for the Dow Jones Industrial Average. And each candle is 1 day. So this was today and this was yesterday. If it's red, it closed down. If it's green, it most likely closed up. The three lines is what I'm going to really focus on. This is the 20-day moving average. This is the 50-day moving average and the 200-day moving average. This is when the correction started, and this is when it got brutal. Just absolutely a mess. So let me scroll back in time a little bit to first show you that like here's July 20th of this year. You can see the green is above the yellow is above the red. You can think of it like a traffic light. I made it these colors just so as I'm looking at my screens, it just makes sense without even having to think about it. But the 20-day moving average is above the 50-day, the 50-day is above the 200-day. Now, these moving averages are something that every trader in the world looks at. So in a way, they can become a self-fulfilling prophecy, but I will just tell you these are critical moving averages, or MAs, when you see me put that in my email. When you see it in this configuration, whenever I say we are in a bullish trend or a technical bullish configuration, this is what I mean. The short term is above the intermediate term is above the long term, and that's called a bullish trend. We would be in stocks. It certainly doesn't mean that every day the market goes up. There are plenty of days that it goes down, but overall the trend is pointing up. I had the good fortune of meeting a gentleman who is called a market wizard, one of the smartest Wall Street traders in history, and I was at his home in Lake Tahoe one time, and it was a small group of people. We were talking about technical analysis. And he said technical analysis can get so complex that you could need a PhD in the magnitude of analysis. And there are, they're called financial engineers. He said that he likes to use the pencil technique. He takes a pencil and he lays it on the chart with the pointy end to the right-hand side. And he said, if it's pointing up, I usually buy things. And if it's pointing down, I sell things. Well, that was the most simplistic description of what we're looking at here that I've ever heard, but it works. It works. So these moving averages just kind of give us an idea of what the trend is. It's an average of what the trend's doing. So this is a bullish configuration. There will be many times that it will pull back, and it will pull back to that 20-day. Look at how it pulled back right to the 20-day. It touched it, and it went back up. This time, it broke through the 20-day, but came down to the 50-day. Yes, intraday, it went down a little bit, but it closed much above the 50-day moving average. That, too, is normal. But here, it came back down to the 20-day. So you'll see that it's very normal that we have these cycles, if you will, in the market, but that we stay in a bullish configuration. Let's go back a little bit further. You can see that the market was trending down. This is June of 2018, and the 20-day moved below the 50-day. Well, that's cause for paying closer attention. It's not cause for alarm. You probably wouldn't put on new trades here. You'd probably wait until it crossed back up. But so this might be called a market under pressure. And at its worst, look what happened. It went down to the 200-day and stopped like a dime and then pulled back up. These are pretty normal changes in the moving averages. Now let's go back over, sorry if this makes you a little bit dizzy, but let's go back over to the right. And here's where the correction that we're in started. And it was brutal, and it bounced back a little bit. And then it started to head down again. Now we've got some reason for concern because the 20-day is below the 50-day. Again, reason for concern. Big reason for concern was when we broke through the 200-day. Normally, that is a sign we're going much lower. In this particular case, we went down for a few days and then we responded and we were back up above the 200-day. The 200-day is critical day, and I'll explain more about that in a minute. And actually, the market really trended up nicely. And when this happens, many times I get emails that say, well, why aren't we more invested in the market? Look how powerful this uptrend is. That's true, but the moving averages are still showing us a different story. And we really use those moving averages as a gauge, as a guide. If the 20-day had moved back up above the 50-day, well, that would have made me happy and we would have been buying securities then. But it didn't. And what this means is this is a short to intermediate term downtrend. We bounced down to the 200-day average a couple of times. Remember, this is the Dow we're looking at. This is the best of the indices that I'm going to show you. Today we broke through it, and we broke through it hard. That's a scary sign. That's a very, very scary sign. This is called a gap, and that doesn't look good. But when I say we're not in a bear market, we're not, because a bear market would be when the 50-day crosses below the 200-day. When that happens, that's called a death cross, and that then suggests we are technically in a bear market. Let me go to a couple other indices to kind of drive this home. Here's the S&P 500. And what you're going to immediately notice on this chart that was different than the Dow is that the 20-day is below the 200-day, which is very significant. And the 50-day is heading in the direction of the 200-day. The 200-day stays relatively flat because it's such a long time frame. There's 240 trading days in a year on average, so that gives you an idea. The 50-day is heading down. If this 50-day crosses below the 200-day, you are going to read in my emails that the S&P just went official into a bear market. So the S&P is in worse shape than the Dow. And let's continue down that road, and let me show you, this is the NASDAQ. Well, you can see the 20 is below the 200. Look how close the 50 is to being below the 200. When that crosses, we're in a bear market. And not all indices go into a bear market at the same time. But generally speaking, I wish there were absolutes, but in this industry there's not. Generally speaking, you focus on the NASDAQ with greater weight than the other indices. I usually put the NASDAQ first, the S&P second, the Dow third. So if this crosses, that's eventually potentially going to drag all the other indices into a bear market. So that's really bad. And that's what I've been talking about in my emails. I just wanted to give you a visualization. And remember, even if we're in a bear market, markets will trend higher. But on average, they'll stay below that 200-day moving average, and we'll have a difficult time of it. A couple of thoughts. Number one, if we get into a technical bear market, I will start to use what's called inverse ETFs. They are ETFs that invest in the different indices like the S&P 500 or the NASDAQ. Let's go back to the S&P 500 for a second. So if it crosses, we will buy ETFs that actually profit as the market is going down. I won't ever buy those unless we're in a bear market, just because there's a little added degree of risk because they are leveraged. They're 2-to-1, not a big deal, but I just believe it's prudent to use those in a bear market. So in a bear market, like now, even though we're not in the bear market yet, we're almost entirely in cash, and a treasury bill is just like cash. And we're doing our daily SPX trades, which I'm going to get to next. But if this crosses and we get to a bear market, in addition to those SPX trades, which trade on both sides, they trade if the market's going up or the market's going down. They are completely market neutral. They don't care the direction. The leveraged ETFs, the bear market inverse ETFs, do matter which direction the market is in. That's why I wait for a confirmed bear market, just to keep us on the right side. So most of our portfolio will be in cash. Maybe 10% of our portfolio will be in inverse ETFs, trying to profit from the bear market. And then every day where there's an available SPX trade, we will go and open one of those. So I hope this helped you at least understand what I'm talking about when I say we're not in a bear market or we are in a bear market. Remember, it's 20, 50, 200. The 20 below the 50 means in the interim term, this is pretty ugly. We're probably going lower, and now that it crossed below the 200, that even exacerbates it, but it's not a bear market till the 50 crosses below the 200. Okay, hopefully that makes some sense. Let me show you something else here. I want to show you the SPX. Bear with me right here. Okay, here is the SPX, and this is basically the spreadsheet that I take a picture of and send out to you every week. I send it on Fridays. So here's the month. We're in November. And each line is drawn under each Friday. So last Friday, the 16th, I sent you the spreadsheet. On the 19th, we did a put trade. We made a little bit of money on it. And then, the end of this week, we had no trade today. And sometimes option prices get really expensive because the volatility is so extremely high. If prices are really expensive, I generally just call a no trade day where the risk is a little bit too high for my liking. Because again, in the RTA, we're always trying to avoid risk wherever we can. And that's one additional way. Tomorrow, hopefully we'll get a trade. Friday, we will not be doing one because the market's just open for a couple of hours. So after tomorrow, if we do a trade, I'll probably send out the spreadsheet. But just to go over a couple of things really quick. Put means we are trying to benefit as the market is going down. A call, we are trying to profit as the market is going up. And what you'll see when I say that the SPX is market neutral or market agnostic, it doesn't matter. Early in the morning, we do this at 6:30 a.m. Pacific time, which is when the market opens, and we start to analyze it about 10 minutes before then. We're looking for what direction I believe the market is going to open. Then I allow the market to open, and then after about 1 minute, I see if my direction call is confirmed. Then I make the trade. Okay, so that's how it works. We're certainly not right every time. But what you can see is we're averaging a win rate. A win just means we made a profit. A loss simply means we had a loss. And I color code it too. Right now, we're at a win rate. And this is not a long period of time, certainly. But I'm expecting to average better than a 70% win rate. If we do that and we manage our losses on the downside and we allow our profits on the upside to be greater, we're going to do really well. With this particular system. This is a once a day, early in the morning, very short-term trade system. That's what this is. I call it the SPX market open trade system. Currently, if you take an average of these returns, we're up 113% so far this month, which isn't bad. And every account, every person that I manage money for has a different account size. So what I did was I chose, actually I took that off. This is the actual return for one RTA client. I used to have the dollar amount. I've taken that out because I felt that it's just not, it doesn't matter. Everybody's up the same amount within a percentage point, but the dollar was different. So I took that off. And then the other thing is right now, I started by trading 1% of the portfolio. It really didn't make a sizable difference. So I've gone to 2% of the portfolio. I'm going to continue at 2% of the portfolio for the next, probably to the end of this month. If we get some more trades in and we are averaging over 70%, my plan, and it's always subject to change, is then to push this to 3% of the portfolio. Continue down that road. And what I'm doing is I'm experimenting. Don't get nervous by that term. I'm always managing the losses, but I'm experimenting with what type of loss management to use. This is called a bracket order, where we would be stopped out automatically at this price, which is down 15%, and we would be closed out automatically at this price, which is up 30%. That's a bracket. Sometimes, if we do one soon, tomorrow, I was going to do today a trailing 15%, because I want to see if I can squeeze out higher numbers on the upside without adding any risk at all whatsoever on the downside. I'll never add more risk on the downside, ever, ever, ever. That won't change. So this column is really for me to remind me what's working and what's not. Now, for instance, this had a T, just means trailing, a trailing stop of 15%, and we made 12.8%. Okay, that was good. This one had a bracket of -15 or +35. We didn't get all the way down to 15, and we didn't get all the way up to 35. So what happens in that case is I'm looking at my indicators on a minute-by-minute basis, actually second-by-second basis, but they're 1-minute charts. And if I see my indicators in any way turn against us, I just close the trade for whatever return we have. Because again, that's just another layer of our risk management. So hopefully tomorrow we'll have another trade. I'm going to do it at 2%. I'm going to do it for the following week at 2%. My goal is to eventually get this up to 5%, but I have no promises as to when that's going to happen. I'm going to take it slow. A lot of it is going to depend on this win rate. And also a lot of it is I just want to see the size of our wins, that we're capturing larger wins than losses. Losses can be as much as about 15%. I say about because the markets move fast. We could hit a 16%, a 17, but it's usually about 15%. So these two trades were good trades, but they weren't more than at least plus 15%. So there's a lot of calculations going in to show you this, okay? So you'll get another one of these tomorrow, and I'll do that tomorrow only because this week is a shortened week, but I'll send this to you every Friday. If you ever have any questions about this, please feel free to shoot me an email. I'm more than happy. One of the values of the governing values of FCM is complete transparency. So these are the actual numbers. This is one client that I take off out of the RTA, and I just post that person's numbers each day. Now, the next thing I want to talk to you about is going to get a little bit more complex, and I don't mean it to, but they're both called SPX. This is the morning market open SPX system. I am now testing another SPX system, which is called, and I haven't made any trades in it yet, SPX 5-minute. So the SPX morning is based on a 1-minute chart. This will be based on 5-minute charts and lots of other indicators. What I'm trying to accomplish is to be able to do 2 to 3 SPX trades a day. Right now, we're only doing 1. I'm getting very, very close to finalizing this system. I'm hoping by December 1st, this system, I just created this spreadsheet so I could start, but that this will be ready. And again, we will continually test it just like we do this one. We want to know what our win rate is. We want to manage our risk on the downside. We want to allow our profits to run. So it's very similar, but it's just based on different time frames and different technical indicators. So unless I can think of a different name for it, SPX is just the name of the S&P 500 index. That's why it's called the SPX. So that's what I'm trying to accomplish. Hopefully that makes sense. The other thing that I've been doing quite a bit that I've kind of mentioned just with little tiny messages in my emails is that for myself and my family, I've been trading futures on the NASDAQ. It's something that is similar to the SPX mornings trades, but you trade 15 times a day. It moves much more quickly, and it's something that I've been working on. It's very, very profitable, can be very profitable, and the risk is managed. It's going to be a portfolio that is completely and totally separate from the RTA, because it's managed under a different set of regulations and regulatory bodies. It's going to be completely optional. It's a very small amount of money that gets invested in it, but the reward to risk profile is more extreme than any other type of investment I know of, meaning the upside potential for the limited downside risk is pretty staggering. So I'll tell you more about that. I'm trading it live with my money and my family money, and it's working really well. But until I'm ready to offer it, which will probably be around the first of the year, I'll just keep mentioning to you and letting you know how things are going. So that's the whole story. You know what a bull and bear market looks like technically. And if you have any questions about this, just let me know. Talk to you soon. Bye-bye.